but the last 20 got denied by the SEC. So the next question is, why does BlackRock think they're going to get approved? They have this 570 to 1 win ratio, right? So people go, well, it's 99% likely you'll get approved. Why? Well, to the same day or the day afterwards, the EDX exchange got announced, and EDX is a non-custodial exchange backed by Fidelity and Citadel and Charles Schwab. So 3 other big Wall Street firms. What's the significance of that? Well, the SEC has denied those 20 spot ETFs, and in the denials, they generally say, we're denying it because we don't see a Bitcoin spot exchange that's regulated and transparent, per our liking. And in the SEC cases against major crypto exchanges, the issue they take is they don't like the idea that an exchange is a broker-dealer and an exchange and a clearinghouse. Those are 3 separate functions. Well, so EDX is just one of those functions. It's just the exchange. It's not the clearinghouse. It's not the broker-dealer. So if you're an industry watcher, you say, well, the SEC can't approve this unless their fundamental objection is addressed or cured. So EDX coming online sets up a situation where the SEC can say, okay, well, it's trading on, between NASDAQ and maybe it'll trade through EDX, and there's a surveillance agreement per BlackRock, and EDX is not a clearinghouse. It's not a broker dealer. So, the crypto industry now has compliant exchanges and a compliant product. So we can go ahead and approve that. Now, I'm not the SEC. I don't know what they'll do. They could do whatever they want to do. It's still possible. Theoretically, they would deny it for any number of reasons, right? What's the materiality of EDX versus all the other crypto trading? I don't know. But EDX did come live in the same week when this news is breaking. And what happened in rapid succession is like 4 or 5 other Bitcoin spot ETFs get refiled. So if you step back and you look at this from the point of view of an indifferent investor or an indifferent industry watcher, the conclusion would be, it looks like a spot ETF probably will get approved. There's massive political pressure to approve one. The circumstances have changed, and now there's a way for the SEC to approve it without backtracking on its previous legal and policy guidance. Certainly, there are a lot of Wall Street entities that have a vested interest in seeing this happen. If you're an institution, one way to get Bitcoin exposure is to buy the underlying asset, but there have been challenges with finding the right exchange to buy it on and the custody arrangement. And so a simpler way to do it is to buy the spot ETF. There are trillions of dollars of capital that is required to invest in a security that trades in these compliant forums is understating the obvious. It's tens of trillions of dollars. So there's a lot of capital that can't buy the Bitcoin or self-custody the Bitcoin. They don't have the charter. Maybe it's against tax code. Maybe when they raised $10 billion from public investors, they raised it to invest in securities, but not invest in commodities or property. So the spot ETF availability is a major milestone for institutional adoption. The approval of a spot ETF is a major milestone in regulatory clarity, which is tantamount to an endorsement, right? The engagement of Fidelity, Citadel, and BlackRock and Schwab in this exercise is, Charles Schwab is literally synonymous with Wall Street, like 100 years of Wall Street. So what you have is Wall Street coming together to offer securities and exchange services and indirectly custody services for mainstream investors. And if we look out about 12 months, if I was saying, well, what are the key milestones to drive mainstream adoption Bitcoin? Well, one of them clearly is a spot ETF. The second is a designation that Bitcoin is an asset class, right? The recognition of it as a legitimate commodity. It's a big deal, and when Jerome Powell says it's not going away, when Gensler and when the head of the SEC and the CFTC both say it's a digital commodity. Well, I mean, digital commodity might not sound like much, but when you go down to the next round, which is like it's a Ponzi scheme or it's a scam or it's tulip bulbs, right? The difference between tulip bulbs and digital commodity is a 0 versus a 1. And I have said before, and I would repeat it again, if it's not going to 0, it's going to a million. It's either nothing, right? If it's nothing, then it's getting scrubbed out and banned. And of course, we now know that it's not getting banned, right? There's no way that Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, Credit Agricole, Banco Santander all decide they're interested in this, right? They're not endorsing a tulip bulb, right? So once you go from 0 to 1, then the question is, okay, well, it's an asset class. If it's not going away, then what's it worth? Well, it's worth 1% of the assets in the world. So 1% drives it up by a factor of 10 to 20, right? Once you get to a 1% exposure. So the recognition as an asset class is a big deal. The availability of a spot ETF is a big deal. The normalization of accounting via fair value accounting, which is the FASB initiative, it's another big deal. And then the halving, right, in less than a year is a big deal. So those are 4 pretty serious milestones that we're staring at right now. And I think, Wall Street and the general community is kind of just internalizing this all in a short period of time. And that's why the bullish outlook.
My question to you is about how specifically the average regular person can benefit from Bitcoin, because we just talked about institutions. Obviously, you're a successful public company with cash flow. You put it on your balance sheet. I understand that. I understand institutions. But the average, the normal person in the US making $60,000 a year, I like a good beer, saving up for a jet ski, got a wife, soon to be wife at home. How can I best benefit from Bitcoin?
Well, I think the best way to think about that question is to consider the alternatives people have. So you're a normal person and you want to save money for retirement or to give to your kids. So you put it in a savings account, you get 5% interest. The monetary inflation rate is 7 or 8 or 9%. You got a negative real yield of 3%. If you end up with a negative real yield of 3.5%, then over 100 years, $1 million saved is worth $30,000. Okay, and so for the average person, saving money in bonds with a 3.5% or 4% interest rate when the currency expands at 7 or 8, that's a losing proposition. You lose 97% of your wealth over the course of 3 generations. So clearly bonds don't work, right? And savings accounts don't work. So the next question is, do I just put all my excess money in the S&P index? Well, traditionally the money supply in the US is expanding at 7% and the S&P index is going up at 7%. So if you save $1 million over the course of your life and you put it all in the S&P index, then in 100 years, it'll be worth $1 million. So that's wealth preservation, but you're not doing any better than that. And that just kind of assumes that, that the S&P 500 is going to be relevant for 100 years and you can stick around the country, but it's like treading water. The next issue is, well, so what I put in real estate? If you buy real estate, you're an average person. Can you buy a building? Probably not. Can you buy a warehouse? Not easy. Maybe if you're a rich family, you buy warehouses, right? Rich families buy warehouses, city blocks, and buildings, but the middle-class person doesn't. So how do you buy $4,000 worth of a building? Can't. Okay. So the issue there is your property rights are inferior when you're buying shares of stock or a security versus the underlying property. If you own the building, you can mortgage the building, sell the building, upgrade the building, build 10 floors above the parking lot that the building has. You can develop the building. When you own a share in a REIT that owns the building, like you own 1/100th of the building, you don't have any of those rights. You can't do anything to the building. You're just along for the ride, getting 1/100th of whatever cash flow the general partner decides to distribute to you. And if they make stupid decisions, you're stuck with them, right? You don't have any property rights. You're inferior in your economic rights. So owning shares of a REIT to get property for 100 years, not a great idea. And that leads us to the problem of securities. What is the problem of security? So you have some money, you invest it in Apple stock or Amazon or Facebook or Google or a REIT that owns a building. The dilutive problem with securities is there are risk factors. First of all, there's a management team. They're going to take 1% every year. They're not doing it for free. They're charging you to manage the company or the building, right? And if you're lucky, that's only 1%. You want to see that in action? Just go look at any ETF. The ETFs charge 90 basis points. If you want to put money into a Bitcoin, Bito, or whatever, they'll charge you 90 basis points just as the management fee. So about 1%. What's the cost of 1% over the course of a lifetime? An infinite duration asset, you would basically multiply it by 20, 25. So it means that when I charge you 1% to manage your $1 million, I'm taking 20% of your money. Okay. I'm taking 20% of all your wealth to charge you 1%. So that's only the first problem. It turns out that when you run a company, you also have you have the risk of labor, right? Your company may unionize. So you've got labor expenses. And what happens to the equity value when the company unionizes? Well, the union just takes all the profits. And the equity values of those companies start to trend towards zero. So labor is another risk. The third risk is your competitors, right? Your competitor may come up with a better product and you end up like Yahoo squeezed out or AOL squeezed out by Google. Well, then your stock's going to zero, right? I mean, how many companies actually had a competitor? Xerox, Kodak,